Today we're talking all about taxes. And specifically, it's about the Tax Cuts and Jobs Act that was signed into law in December of 2017. Here's what you need to know. Basically, what the Tax Cuts and Jobs Act did is it slashed tax rates across the board for both corporations and individuals. The maximum individual tax rate went from 39% to 37.6%. The 25% bracket went to 22%, and the 15% bracket was dropped down to 12%. So, what does that mean? Tax rates, even though we feel like we all pay too much in taxes, are at a historic low federally. Now, here's what we also know. In the future, in 2026, all of these brackets in the tax laws sunset, and the brackets go back to where they were in 2017, which is higher than they are now. So here's the opportunity. If you have significant assets in tax-deferred retirement accounts, IRAs, 401ks, 403bs, pension plans, this is the time to develop a strategy to start moving some of those assets from tax-deferred accounts into tax-free accounts. Roth IRAs, Roth 401ks, Roth 403bs. The idea being this: if we think tax rates may be going up in the future, which likely they will be federally, it would make sense to start moving assets over now, paying a smaller amount of tax, and develop a strategy where in retirement you can produce your income stream in the most tax-efficient manner possible, because now you have investments in tax-free, tax-deferred, as well as after-tax taxable accounts.
Are you prepared for retirement? Sign up for a free financial assessment with a certified financial planner professional from Pure Financial Advisors.